Welcome to today's episode of Wall Street Station. We're gonna have a very captivating subject, the intersection of artificial intelligence and S&P 500. We're gonna discover whether there is a chance to make this dynamic narration a catalyst in this very hectic seasonally moment of fourth quarter on S&P 500. So that's the time where innovation meets investment, and we're gonna discover the very bottom of what's going on and what the data is saying about the Santa Rally Claus based on innovation that's called AI boom. So we're gonna discover many things related from earnings, also the historical patterns and technicals as well. So thank you very much for sticking around, and we are just jumping through the first element and jumping to attempt to answer what's next for S&P 500. So at first, let's head on whether there is a recession or not. Bank of America finds that right now, the index of S&P should reach the 5,000 points in 2024. So we are heading for new highs. And could it be possible? Yes, as we are right. It is pre-election. Yes, that's normally a very one that is pushing the valuation even higher, and the first quarter of the next year may be under the question, under the kind of a positive outcomes with the moderate returns, not maybe as high as this fourth quarter is showing us, but still having a right chance to beat the previous highs and head straight through this highs of 2021. Right now, the stocks are still far from pricing in a recession, and this positivity around the broad market is right now spilling over, spurring hopes for that the soft landing will be somewhat possible. But even though investors seems very committed to chase the soft landing narrative, bears are still continuing to speculate on when the market will peak. And you all know what does it mean. Right now we are, however, pushing the valuation higher, and as long as this narration lasts, we shouldn't bet against it. In terms of earnings, we can find right here that using trailing reported earnings, we are right now bottomed out somewhere in the beginning of 2023 and supposedly building another wave higher with this third quarter. We have some hopes that even though in some metrics, some economic metrics, we have been thrown in at the deep ends by showing that this next year may snarl up for all of the bulls. But right now, the positivity looks like the V-shape may eventually push this monstrous gains even higher with this very astronomical percentage points of return for Nasdaq overall. So P/E ratio for S&P 500 showing that we still have a room to rise. In terms of seasonality, that's an obvious element that we are right now in the on the brink of November and December. That's normally where we should rise toward a new highs, supposedly by this metric, even in its merely 1 month. Seasonally, we had around 2 to 3% of return at the end of fourth quarter. But as this year was of a high momentum, the appetite right now for the higher return than the median out of the previous 70 years is even higher, and this appetite may cascade a even greater demand for stocks in this period. So right now, none of the austerity is being seen in the stocks, and that's what you observe also in PE multiple. That's right now still having some of the room for growth as well. So from Thanksgiving to second day of New Year, we should have a nice return, and everything points at it. In terms of S&P 500, tech stocks at all-time high relative to S&P 500, and that's what we can find right now. The market is very narrow. That's why some of the bears are trying to find its edge on this very extended market, but right now they are still grinding with the teeth and not with no option to find a top, and there is almost nothing that may paint a grim picture for the index in this time that we are right now in front of. At 22x, S&P 500 trades over 40% reach versus the long-term average, and that sometimes may spark the red alerts for the holders. But right now, even though this metric is pretty vocal, we are tiptoeing around the season that may eventually have bigger hopes spared for the positive returns rather than the pessimism overall. So I don't really detect sharp spikes to the downward, so that may eventually push us even higher. Let's find out what about the inflation and how the S&P 500 citing inflation, companies citing inflation looks like. So right now we can find that fewer companies discuss inflation, marking a decline right here. So that's overall positive gauge, and we should stick to this. So this earnings expectation may even rise from here with this inflation fading away. So ABC strategy sees stocks at record high in 2024. That's another metrics that also finding that we should rise from here, but I wouldn't be sticking around very much to what the central banks or other investment vehicles are saying, as normally when the majority of analysts are betting for some of the outcome, it usually doesn't happen. So it also in some terms it brings some hope, but also bearing some of the remark that everything may not become a reality. But however, I'm still kind of positive for this. Valuation currently suggests 4% price returns over the next decade, and that's also just spiking and also emerging the investors imagination. So there is what S&P 500 annualized forward 10-year return shows, and Bank of America shows that not many events that may thwart that positivity, and overall, even though those returns may not be very satisfactory, we are still not finding any way to go through the hard landing, and the BOFA doesn't find anything alarming to see. So when it comes to reverberations right now, the S&P 500 is very high shorted, and normally it doesn't really bode well for bears at all. So that's why we may have another continuation of the short squeeze that has been observed in the second half and the end of the first half of November this year on the indexes. When it comes to positioning, that's also very crucial. We can find that managed money that's usually we look at that are marked on a green line right now is finding that they are enlarging their positions. So it means we need to be a little bit more cautious related to what it does. It shows that normally managed money has just increased their positions by the time of the temporary spikes, but right now it looks like the shorts had been squeezed. That's why they need to be just evacuating out of the position. So that's even though that's thought-provoking, I do find that doesn't really bear any type of a shockwave for the market. However, I do find that it mostly like bearing a bit more optimistic of an outlook of what has come, and by the necessity of pushing those managed money to contrary position, we may have another rally extension yet to take place. That also refers to the next metrics we can find. There is a comparison of the sizes of different type of leverage positions, whether it's on long or short. You can just study it by yourself. However, we can find that managed money are still the large in terms of percentage point market participant, and it has erased almost all of the positions back during the downturn of the first half and second half of September. So right now they are looks like getting back toward what may come next, and maybe joining the train once again. Despite overheated market, there still remains some hope for continuation. So the timeline of sentiment shows we are approaching a extreme grid, so we need to be cautious anyway. But S&P 500, if you just have a look at what's going on the market on TradingView, we can find that we are approaching the prior highs of July and yearly highs, and right away we should eventually manage to go to 4600s in this year supposedly, and then maybe kind of a correction before another rally upward. So what I expect is this kind of a rally that may looks like this. However, you need to be, as always, very cautious in related to what these candlesticks are showing us, what the price tells us, and for now I do find that there are nothing for here that may remark a stark warning for traders or investors. So considering all the aforementioned metrics and this technical chart, we can find that some of the corrections should take place, but it's supposed to get us through this 4600s unshaken, and then having a golden path right to this supposedly new highs somewhere in the 2024. So we are in this thrill modes, and with this final thoughts, I would say that right now stocks exhibit seasonality, and with November to April historically favorable, we should really consider that that might be very, very fine period for us investors. So since 1950, the best 6-month period for the S&P 500 extends from exactly November to April. So we should have overall positivity around. That's why I'm just staying by the side of the bulls. But let me know in the comments section below the video whether you're buying or just holding, or even maybe selling the US index in terms of what the contrary approach usually finds. So if you have enjoyed, just hit this like button. Thank you very much for sticking around, and see you in the next episode on Monday.